Hey everyone, welcome back. My name is Levi Woods. This is Drawbridge Finance, and I'm super excited today because I'm going to be unveiling my brand new complex option comparison calculator, which I designed because of one of my patrons. He actually requested it and said, hey Levi, is there a way for you to design a spreadsheet that will help us make better decisions when we're doing these complex trades? Now, my patrons know I like to make trades that are going to make me money, and I love being an options trader because I can really tweak my trades so that I can get exactly the right amount of money for the right amount of risk, and I can control it all before I place the trade, which is pretty awesome. Today, I'm going to show you how the calculator works. Now, if you're brand new to the channel and you don't already subscribe, remember to hit that button down below because our goal here is to get rich together. I build tools for traders, and today I'm showing one of these off. So let's take a look at it. Now, if we jump into this is what the spreadsheet looks like. Once you've downloaded it, you can make your own copy, and it's pretty simple by design. It looks very, very similar to my rolling options record keeper, which was kind of based off of. The idea here is that I'm going to be able to graphically compare different option strategies. Now it's preloaded here with Apple. Now Apple's reporting earnings tomorrow, and I have a potential trade idea. So I want to put it on and see if I can tweak it to exactly what my assumption is. Now I can put in any stock here. If I want to put in Facebook, I just type in FB in cell D2 where it says underlying symbol, and will automatically update that it's US dollars, and it will give the current share price of 174, and it updates it on the chart down below. Anything I type in here, BAC, if I type in any ticker, it will pull up that information and automatically update it. Now, what I'm going to look at is Apple. So it's currently trading at 156. Now, for simplicity, I'm going to start this as if I have no position on whatsoever. So in this case, I'm going to say that I own no Apple shares, which is an optional attribute of the chart. The spreadsheet is comprised of three basic comparisons that are going to be charted out on here. So there's going to be a blue line, a red line, and a yellow line. And the information that gets entered into each area is going to dictate what the line looks like. So let's head over to my brokerage platform and look for a potential trade idea that we can plug into the calculator. I'm looking at a date past the earning cycles by 2 weeks, and what I'm doing is I'm going to set up a very, very simple trade, an Iron Condor. Now this is generally a neutral strategy. So on my IBKR settings, you can see there's this dark blue center line, and I'm just going to go up and I'm going to purchase the first lighter blue put on the put side. So I'm going to buy one put, then I'm going to sell the very top or the lowest number put in the middle section, this blue line. An Iron Condor is generally a neutral strategy. So if we look at this, we're selling the 23 deltas. I'm assuming, looking at this chart, that Apple's going to move up. So I may not want to do the 23 delta. What I want to do is the 17 delta. So let me click on that. The next component of this is to say, well, this is a $5 wide spread, so I should have equal risk on both sides to make this a neutral trade. And I'm going to put a $5 wide spread on this side. So I'm doing a bull put credit spread and a bear call credit spread on the same underlying. So if the stock is trading above 175, my max cost to buy out is going to be $500. And if the stock trades below 140, my max cost to buy out is going to be $500. The max profit on this trade is going to be the credit collected. So if we pull this up, the credit collected, we're going to say is $1.56. Now this, if we look at the profit profile of this, we can kind of visualize what this trade is going to look like at expiration. So in 2 weeks, if the stock was trading down at say 125, then I could lose up to $365. This is calculated based on the credit that I'm collecting today, which is my max profit, and then the reduction of the $500 that I would have to pay to close out. Now this is a pretty standard trade, and it's pretty neutral. But you'll notice one thing here is the break evens. We've got 143 and 171. So I'm going to go down to the chart, and I'm just going to put these, just mark these on here. I'm going to say the 171. I'll be pretty loose about this so we can see. And then we're going to put on a 143. That is a fairly neutral condor. It's got a 62% probability of profit, And if I was not looking at anything and I had no assumption, then I would look at this and that's probably the trade that I would put on, because it's got equal chance of the stock going up or down and breaching those lines. Now, in this case, I might have an assumption that differs from this. And looking at this chart, I think that especially with Microsoft reporting good earnings yesterday, Facebook having great earnings today, I think that Apple's actually going to rally through this. So I don't want to have any risk to the upside. What can I do to adjust this? Well, the first thing I can do is I can come over here and I can lower down this short strike. I can make this Iron Condor have a broken wing. So this is reducing my upside risk and it's raising my upper break even. You can see that the upper break even is now 173 compared to this 171. So let me just move that up a little bit further. So that is the new break even. This is still not exactly what I want. What I want to do is I want to have something very similar to this. I want to have the break even down here at the bottom, but I want to have no upside risk at all. And this is just my personal assumption in this trade. What happens if Apple rallies up to $180, which it could easily do? Well, in this case, I'm actually going to lose money. I'm going to be down $150 on the trade because I'm going to have to pay to buy out this call spread. How can I adjust this? Well, there's not much I can do because I've got these really tight spreads on this side. So this is where the comparison calculator comes in. Let's take a look. We're just going to simply enter the trade. So it starts with a long put, sell a short put. We're going to sell a short call, and we're going to buy a long call. The red is highlighting because this is an incomplete line, and it won't chart unless you've got a complete line, or it will chart incorrectly. So make sure it's filled out. If you're seeing red, there's a problem. In this case, I'm going to put in 140, 145, 170, 250, and 175. Now I'm going to do one contract of each. And I'm going to be opening this for a net credit. Now it's showing me a net credit of around $1.17. So we're going to put in a net credit here of $1.17. It immediately charts it out. We can't actually see the whole condor. We can only see part of it. And there's this, it says the increment for displaying range. We just adjust that number. We're going to make it a little bit higher. We're going to make it $1. Now it zooms the chart out and it allows us to look. So now this should match what the brokerage has. We could lose up to $380. We could make up to 117, and we could lose 133 if the stock goes up to 180. So the broken wing Iron Condor. Now I don't love this trade because I am assuming that the trade could go up to 180. So what can I do? Let's clear this off and take a look at another trade and compare it. One of the things that comes to mind if I want to do a no upside risk trade is a put ratio spread or a broken wing butterfly. A broken wing butterfly has limited downside risk. So let's take a look at what that's comprised of. I liked that long 140 put, so I'm going to buy that on this side. Then I'm going to sell two of the 150s, and I'm going to buy a 155. I'm going to buy a second contract. So this is comprised of two spreads. We've got a bull put credit spread and we've got a bear put debit spread. They're both being entered for a net credit. So in this case, I can pull this up and I can see I would open this trade for about 40 cents today. That would be my assumption. And if we look at the profit loss chart, we can see that now, if I can get 40-cent credit, then if the stock goes up to 180, I'll get to keep the $80 because these are all puts. They'll all expire worthless, and I'll make $40 on the trade. But if the stock drops down to around 150, I could make up to $500. And this is very, very nice looking trade. Now, there's also a little bit more risk. I could lose up to $500 in this particular case. Now, one of the things I don't like about the brokerage is that they're always assuming that my entry is what the ask price is. And the ask here is 0, but I'm not going to open it for $0. So let's enter this trade into my comparison calculator for what we actually think we're going to get. Similarly to the blue trade, I'm going to just choose my options. A long put, we're going to do a short put, and then a long put at different strikes. We're going to do the 140, 150, 155, and then we're going to place the same thing that says in our brokerage, buying 140, selling two of the 150s, and we're buying one of the 155s. We're going to do this for a net credit of 40 cents, and we're doing one of these contracts. So it's just a multiplier of one of each of these. Now, this is where the magic is. It starts to show me the comparison. So I can now compare the previous trade that I had open and this trade, and I can say, wow, okay, well now if the stock goes up to 180 on the broken wing Iron Condor, where I would lose 130 bucks, if If I was scrolling over this, $133. On this trade, I would actually make $40. Well, that's pretty awesome because my assumption is that the stock is going to go up, but I'm taking some of the risk out and I could potentially make up to $500 if the stock went down, which would be pretty awesome. So now let's get into some really complex stuff. What if? Now I've already played around with this and I figured out what I was going to do before I started this video, and I've come up with a trade idea that I quite like. I'm getting rather tricky about it, but I'm using the profit loss profile to tell me exactly how much I'm going to make. So in this case, I'm going to open this trade for a net credit of around $80. We'll say that we can open this for $80 and shows me an 80% probability of profit. I no longer have any upside risk. My break even's at 143. So the break even is right down here, exactly where I want it to be. And if the stock goes up, I'm going to make $80 at least. So let me plug this trade into the comparison calculator. Just like before, we're going to do a long put, then we're going to do a short put, a short put, and then a long put. And the prices are going to be 140, 145, 152.50, and 155. These are all puts. I'm going to buy 2 of the 140s. I'm going to sell 2 of the 145s, and then I'm going to buy a bear put debit spread. And the whole thing's going to be entered for a credit of $80. And now all of a sudden I have some comparison. I've got 3 different trades loaded up on the price. I can come over here and I can look at the numbers of what happens if the stock trades down at $129. Well, the Broken Wing Iron Condor is going to lose $383. The Broken Wing Butterfly is going to lose $460 on this trade, and the Broken Wing Put Condor is going to lose $670. We can kind of compare, so definitely some more risk on this side. But one of the things that's quite interesting is that looking at my assumption. Now, remember, my assumption is that the stock is going to go up. Well, what happens in this case? What happens if the stock goes up to 180? Well, in this case, this Broken Wing Put Condor, this yellow trade, actually could make $80 rather than the Butterfly, which only makes $40, and compare that to the standard Condor, which would actually lose $133. So I'm definitely ruling out this blue trade. Now, the other thing that's nice about this is I actually found a trade that has a slightly lower break even. Now, I'm pretty confident that Apple's not going to trade down as low as 140, especially after the recent earnings of some of the other major tech sector, but there's a chance it could sell down a little bit. And in this case, I actually have a very wide profit zone. I could make $330. So I'm risking $670 to make $330 potentially. And if I don't, I actually have a really great return on investment because I'm taking a $670 risk and I'm still making $80 if the stock goes up. So this is a way that I can use this calculator to enter a brand new trade, and I can compare to see what potential trade might be out there that I can make more money on. And that's as simple as that is. And just that simple data entry gives me that graphical interface, and I can make a really informed decision based on what is going to happen at expiration. Now, you'll notice a couple of things about this spreadsheet. One of them is that it has no dates. I completely removed them because a lot of times when I'm trading these complex options, I'm letting them expire at the same time anyways. If I'm playing with diagonals, I have to really understand extrinsic value, and I have to know how theta decay works, especially over an earnings trade. So those types of trades are much harder to kind of map out in this kind of simplistic way. So I chose to just eliminate the dates altogether and just look at the raw data because we're looking at the expiration value only. Now, if you're interested in getting a copy of this spreadsheet, it's available over at drawbridgefinance.ca, as well as all of my other spreadsheets. This is just part of what this spreadsheet does. This is for opening a new trade. But one of the things that I built into it was the ability to say, well, what happens if I'm adding to an existing position? What if I have a long stock position? What if I have another options position? How can multiple options positions work together? And how can I see that graphically before I put in the trade? And I'm gonna have to save that for another video because it's pretty awesome. So if you don't already subscribe, click the button down below. If you like today's video, give me a thumbs up and let's get rich together. Thanks so much for watching. See you very soon.